Right now, things feel pretty calm. The markets actually hit new highs over the summer, and it feels like a completely different world from just 6 months ago, back in early April, when the entire global financial system was staring right into the abyss. We watched a multi-trillion-dollar panic unfold that really felt like a big one. And yet, we bounced back. I mean, faster than anyone could have possibly imagined. So that brings us to the big question. Was that crash in April a crisis we actually survived? Or was it just a warning shot for something much, much bigger? To really understand where we are now, you have to remember the absolute panic of that moment. This quote from investor Bill Ackman, it just nails the feeling in the air. The fear wasn't just that stocks were falling. The fear was that the entire economic engine was about to seize up completely. This was a full-blown crisis of confidence. All right, so first, let's just rewind the clock to that insane week in the spring and break down what really happened. How did one single policy announcement manage to bring the global markets to their knees? So it all kicked off on April 2nd. That's when the Trump administration announced a massive new set of tariffs. The market's reaction was, well, immediate, and it was brutal. The very next day, the Nasdaq had its worst session since the pandemic. A day after that, China fired back, and the Dow just cratered, falling over 2,200 points. I want you to think about that number. In just 48 hours, global markets vaporized $6.6 trillion. Now, a partial pause was announced on the 9th, but even that wasn't enough. The uncertainty sent markets plunging all over again. It was just pure chaos. The scale of the damage here was just historic. We are talking about the largest two-day percentage loss in history. The S&P 500 shed more than 10% of its value. The Nasdaq lost a staggering 11.8%. This wasn't a slow burn. It was like falling off a cliff. Every major index was just a sea of red. And right in the middle of this historic meltdown, this was the message coming out of the administration. While Wall Street's so-called fear gauge was spiking to its highest level since 2020, the public stance was one of complete and total confidence. Honestly, this contrast just poured more fuel on the fire, adding to the sense of wild uncertainty that was gripping everyone. But here's the thing that made this panic truly terrifying. It wasn't just about stocks. See, money fled into the bond market, like you'd expect. But then, in a move that shocked everyone, the bond market itself started to crash. The Associated Press called it a freak sell-off. Yields on 30-year U.S. government bonds, which are supposed to be the safest asset on planet Earth, saw their biggest one-day spike in over 40 years. That wasn't just a red flag. That was a signal that the very foundation of the system was starting to crack. And then, just as fast as it all fell apart, it all came roaring back. The recovery that followed took us from the brink of total collapse to a record-breaking rally. This is the second half of the story, and honestly, it might be even more unbelievable than the first. The turnaround was absolutely dizzying. On April 9th, the administration hits pause on some of the tariffs, and in response, the S&P 500 has its single best days since the 2008 financial crisis. By the middle of May, it was like the crash never even happened. The market had erased all its losses for the year. And by the end of June, the S&P 500 and the Nasdaq were both closing at new all-time highs. The crisis was apparently over. So, okay, this brings us to the central puzzle, right? If we got this perfect V-shaped recovery and shiny new market highs, why are so many serious economists still whispering words like 1929? Why are they warning about some kind of unavoidable reckoning? What did that April crash show us that this big rally has been trying to hide? The answer, according to a growing number of experts, is that the panic back in April, well, that wasn't the real problem. It was just a tremor. The real danger is a massive systemic issue that's been building for years, and they have a name for it: the everything bubble. So, what exactly is the everything bubble? Well, it's the idea that years of super low interest rates and just massive money printing haven't just inflated one little part of the market, like tech stocks in 2000 or housing in 2008. No, this time it's everything, everywhere, all at once. Stocks, bonds, real estate, you name it. All of it pushed up to historically crazy levels, all floating on a giant sea of debt. And the fuel for this bubble is debt. An unprecedented, truly mind-boggling amount of debt that is propping up the entire global financial system. And this, right here, is the first huge warning sign that something is fundamentally broken. $324 trillion. Just let that sink in for a second. That was the total global debt figure in the first quarter of this year. But honestly, the really scary part isn't just the size of the number, it's the speed. It grew by $7.5 trillion in just 3 months. The world is getting deeper and deeper into debt faster than ever before. And here's the real problem with that. We're not getting much bang for our buck anymore. The amount of debt we're taking on is growing way faster than the actual economy. It's like we have to keep borrowing more and more money just to keep the economy standing still. That's a classic sign of a system that's becoming super inefficient and dangerously unstable. So where is all this debt hiding? Well, it's everywhere. Governments, big corporations, regular households like ours. And while developed countries hold the most debt in total, the fastest and maybe most alarming growth is happening in emerging markets. Their debt levels have just skyrocketed, leaving them incredibly vulnerable to any shock in the global system. Okay, so this brings us to the second major warning sign. If the whole economy is built on such a shaky foundation, what's been holding everything up since that scare back in April? Well, the answer seems to be one thing and one thing only: AI. The big question is it a real economic revolution, or is it just the final, craziest phase of the everything bubble? So here's the bull case. According to George Saravelos over at Deutsche Bank, the insane amount of money being poured into AI right now, building data centers, developing new tech, is pretty much single-handedly propping up the entire economy. He argues that without this AI boom, the US would probably already be in a recession. But here's the catch, and it comes from the exact same guy. For AI to keep saving the economy, the current pace of investment can't just continue. It has to keep growing at a parabolic rate, an exponential rate, and as he points out, that is highly unlikely. You can't just grow to infinity. It basically suggests the entire recovery is balanced on a knife's edge. And the exposure to AI is just extreme. Get this, half of all the S&P 500's gains this year have come from tech stocks. Analysts are out there openly screaming that investors are dramatically overexposed to this one single theme. And even industry insiders are sounding the alarm. Baidu's CEO predicted that 99% of the companies jumping on the AI bandwagon simply won't survive. It looks an awful lot like the dot-com bubble all over again, but this time with way higher stakes. So, when you put all of this together, what does the future actually hold? Where is the real risk hiding? We have to ask ourselves, was April just a bad week we got over, or was it a terrifying glimpse into the system's true fragility? This slide, right here, gets to the absolute heart of the matter. Analyst Nigel Trimmer uses this powerful analogy. Prices are the smoke, but the market's plumbing is the fire. We all see the smoke, right? The high stock prices, the crazy real estate values, but the real danger, the fire, is hidden deep inside the market's plumbing, in things like hidden leverage and complex financial products that can cause the entire system to just seize up under pressure. And that is precisely why the April crash was so important. It wasn't really a debate about whether stocks were too expensive. It was a failure of the system's most basic functions. For a terrifying moment, liquidity, the simple ability to buy and sell, it just dried up. Trust evaporated. The plumbing failed. And that is a much, much scarier problem than just an overvalued market. Trimmer's quote just perfectly sums this all up. Everyone is looking in the rearview mirror for a repeat of 1929 or 2008, but the next crisis almost never looks like the last one. The real risk isn't in the price tags we can all see. It's in the complex, fragile structures that are hidden just beneath the surface. Which leaves us with this final, really unsettling thought. That incredible recovery gave us all a sense of relief, right? A feeling that we dodged a bullet. But if the everything bubble is real, and if the system's plumbing is as fragile as it looked back in April, then that event wasn't the crisis. It was just the tremor before the real earthquake. And the big one? It could still be on its way.